Okay, good morning, everyone, and welcome to the first of our three webinars this week. We have a plethora of ASX microcap companies joining us this week, and I would like to welcome our first two here this morning. And I'm just going to run through a couple of intro slides, and then we'll kick it off with our first presenter of the day and the week, indeed. A quick hello from me, Mark Tobin, for anybody who's joining us for the first time. I'm the founder of Coffee Microcaps. For all our regular attendees, you're very welcome back. Quick shout out to DMX Asset Management, who are our sponsors for our virtual events here, Coffee Microcaps for 2026. If you are looking for a active fund manager in the small and microcap ASX space, please do check out their website for the relevant PDS and TMDs. Or indeed reach out to Stephen or Michael, and I'm sure they'll be happy to answer any questions you might have or look for further information you require. Quick hello to our friends from ASIC who might be joining us this morning. Welcome as always. For anybody who's joining us for the first time, the companies that tend to present on here, capped under 300 million, our definition of a microcap, in revenue, approaching cash flow break even, or indeed are already profitable. We tend not to have companies from the resources or biotech sector and what I like to call industrial microcaps, which kind of spans every other sector and business. In this session this morning, we have another one this afternoon. We've got two companies presenting this morning, 30 minutes each, which we'll kind of break down to a 20-minute presentation and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function, which makes it easier for me to moderate the questions when we get there. Please note the webinar is being recorded, as are all our webinars. So if you can't join us live, you will get them on the YouTube channel generally the following day. You can follow us on Twitter, YouTube, as I said, for the recording of this webinar and the rest of the ones for the week and all our previous ones. LinkedIn, and I do write a free monthly newsletter that comes out on Substack, and then next edition of that will be coming out early next week after all our webinars this week. Our first presenter this morning is going to be Gavin Evans, board chair of Elixinol Wellness. Will be joining us for the first time, and then we will be welcoming back Adam Boyd from Volt Group then after Gavin. And with that, I will stop sharing my screen and hand you over to Gavin. Gavin, if you want to start sharing your presentation, I'll let you know once it's coming through.
Thanks, Mark. That should be coming up now. Just going into presentation mode.
Presentation mode, yeah. Yeah, just click continue to share. That's fine.
Yeah.
Yeah,
great.
That looks good. Gavin, you can take it away whenever you're ready.
Excellent. Thank you, Mark. Good morning, everyone. And thanks for the opportunity to share with your audience what Elixinol Wellness does and how we're progressing towards being a profitable platform for growth. Importantly for this audience, why that creates some good opportunities for investors to benefit. It's good timing to come on this morning. We've just released our full year results for FY25, so I can share the story around those results and how they align with our vision for the business moving forward. Before I do that, though, I will introduce myself and my role in the business. I was appointed chair of the business in December 2025, and it was a pretty pivotal time for the business. I'd been advising the group since around August 2025. In terms of my background, most recently I founded a business called Openway Food Co, where we built a vertically integrated category leading portfolio of better for you brands. Brands such as Red Tractor, Table of Plenty and Keep It Cleaner, which are very prominent in our major supermarkets and our independents. That experience of building brands, strengthening supply chains and integrating businesses to deliver scale is highly relevant for EXL today. My focus is on financial and operational discipline, targeting scalable, high margin categories and aligning our cost base to those core revenue drivers. I've also got proven experience in M&A. My mandate is clear: to create a solid foundation on which to build scalable growth. And I can now say with confidence that we're operating from a stronger, more focused position than we were 6 months ago. So what does Elixinol Wellness do? Elixinol Wellness is a sustainable nutrition and wellness company operating in Australia and the US. We run a vertically integrated model, controlling production, manufacturing, and distribution. Our portfolio spans nutrition, wellness, and superfood ingredients, and our products are sold through grocery, wholesale, and e-commerce channels. And in the US, Elixinol branded hemp and nutraceuticals have been well supported in that market for around 10 years. Together, this gives EXL a scalable, diversified platform to leverage growth both domestically and internationally. I view it as a great foundation on which to build our vision. We'll dig a bit deeper into the business and our future plans later in the presentation, but given the results are hot off the press, let's turn our attention to the FY25 result. As you'll see shortly when I turn the page, FY25 was a transformational year for the company. We had a deliberate reset of the operating model and a sharper strategic focus on higher margin categories and channels. The full year results reflect a year of two distinct halves. In the first half of calendar year 2025, our gross margins were under pressure due to legacy contracts and a range of unprofitable products. We also incurred significant one-off costs to fully integrate prior year acquisitions and streamline operations. In the second half, and particularly in Q4, we saw clear evidence that the initiatives undertaken in the first half were starting to deliver tangible financial results. Our revenues increased, gross margins expanded, and the cost base was structurally lower and cash flow improved. So if we look at our F25 highlights and look at the year as a whole, our revenue was up 3.6% to 15.5 million. Strong revenue growth of 8% in Australia was partially offset by weaker revenues out of the US. I'm very pleased to report a significant increase in higher margin e-commerce sales in Australia, up to 4.3 million, and that's over 160% increase year on year, which reflects our targeted efforts to diversify our revenue streams. Gross margins expanded to 39%, but importantly, drawing your attention to the Q4 gross margins, they increased to 42%, and we expect to maintain those higher margins moving forward. We had a full year adjusted EBITDA loss of 3.4 million. But again, the important point to note here is that the EBITDA in Q4 was positive and the operating cost base was reduced by 30% Q4 FY25 versus the equivalent quarter last year. So look, we're obviously not ignoring the poor full year performance in terms of that adjusted EBITDA loss. However, I encourage you to focus on the results of Q4 as being more reflective of what a transformed EXL looks like as a business and what we can deliver moving forward. Understanding also that the investment in integration and efficiency in early 2025 that negatively impacted the full year result is now clearly moving us along that path to profitability that we've been speaking about. That's why we're confident that the underlying financial performance improved throughout the year. And as I said, this is clearly evident in the Q4 result. So this slide reinforces the key points about our revenue mix transformation, driven primarily by the Healthy Chef and through our e-commerce channels. E-commerce sales were up 160% year on year, and in channel mix terms, it grew from around 20% of our revenue last year to 40%, or almost 40% in FY25. Similarly, the key point here is that Q4 result, which stands out not only in the last 12 months, but in the history of the business. EXL has not delivered a normalised profitable quarter or a cash flow positive quarter before. And whilst this is a major milestone, more work needs to be done, and we remain stubbornly focused on continuing to reduce cost and improve margins. So after all the heavy lifting earlier in the year, this structural cost reduction of 30% PCP has started to take hold. Not surprisingly, that level of cost reduction is not easy to do. It involves tough decisions on resourcing and pretty much every other P&L line from a cost perspective. But as you can see, it's starting to deliver results. And this significant cost reduction has been fundamental in repositioning the business with what we now see as a right-sized cost base on which we can start to deliver sustainable growth. So off the back of that Q4 performance, we're now looking ahead to 2026 with optimism. We see significant growth potential across our key product lines. We have a more disciplined, capital efficient and diversified business, and we expect improved profitability in FY26 and beyond. I'm pleased to say that we now have a solid foundation for both organic growth as well as M&A opportunities. So that brings us to a deeper dive in what EXL is today and our vision for the future, making the case for why it is a platform that is now ready to scale. EXL has a bold, ambitious vision to build a portfolio of premium branded health food assets supported by Australian manufacturing and positioned for global growth. Premium health brands are where structural consumer growth is occurring. There's strong brand loyalty, better margins, and long-term value. Australian manufacturing gives us cost synergies, quality control, supply chain resilience, and authenticity, particularly for those export markets that we want to target. Global growth ensures that we can scale beyond the Australian market. This vision is about a tight thematic scale and building a platform, not just a collection of products or brands. So let's talk to that platform. EXL is a diversified platform built for longevity and everyday wellness. The business is structured around three key streams: nutrition products, which includes functional foods and beverages; supplements and wellness products, which covers dietary supplements and nutraceuticals; and superfood ingredients, where we have B2B supply and also use in our internal product range. This brand and product diversification captures multiple growth opportunities while maintaining high margin, scalable products. I'll share later in the presentation how this aligns with the wellness tailwinds and mega trends. Our brand portfolio supports growth in both our current revenue and SKUs, but also new product launches and opportunities in the space. We operate 6 core brands, with the majority of the revenue coming from the top 3 on this slide: Hemp Foods Australia, The Healthy Chef, and Australian Primary Hemp. Those brands make up 75% of our revenue. Mount Elephant is being reset for growth via a strong innovation pipeline. And Soul Seed is a youthful and modern brand targeting healthy snacking on the go. While the US-based Elixinol CBD business continues to contribute to the group, we're navigating through a changing regulatory environment before deciding if we re-establish a growth profile or proceed towards exit with that part of the business. But this portfolio allows us to leverage strong brands while innovating and supporting our premium health platform vision. As you can see, EXL operates diverse channels spanning B2B and B2C. Retail partnerships include the majors such as Woolworths, Coles, Costco, Aldi, and independents like IGA and Harris Farms. E-commerce channels such as Shopify and Amazon are growing, and they give us that direct consumer access. And we're also re-establishing our dominant position in the B2B hemp supply, leveraging manufacturing capabilities and strong industry relationships. This multi-channel strategy de-risks the business and drives growth. So that should give you some context as to why the business structure, our brands and channels are a solid platform for growth. So looking forward to our strategic outlook for 2026 and beyond. There are clear consumer tailwinds supporting the health and wellness market. Longevity is reshaping wellness, with very high consumer prioritization around spend in this category. Functional foods as a medicine is a major purchasing and consumption driver, and EXL is very well placed to take advantage of these tailwinds. We're now executing against these wellness megatrends. The focus for FY26 and beyond is converting these trends into revenue and margin growth. Cost control remains constant, and capital is directed to parts of the portfolio with the strongest mix of growth and return. In D2C or e-commerce, investment is concentrated where returns are the highest. The Healthy Chef is the main driver of growth and margin, while the Elixinol US brand has had a recent refresh and is focused on improving conversion, retention, and lifetime value. In retail, everyday nutrition drives scale and repeat purchases. Our innovation focuses on products that earn shelf space as categories grow. A good example of this is our soon-to-be on Coles shelves first ever sustainable pancake shaker. Hemp remains a core platform. We're the largest hemp brand and ingredient supplier in Australia. Contracted volumes for 2026 are significantly higher than they were last year, and our vertically integrated model supports steady growth without extra capital. To close, I can share with you that our FY26 outlook is anchored on 4 key pillars. Number 1, operational momentum. We need to continue to improve performance off a right-sized cost base and drive stronger margins. 2, cost efficiency. We need to maintain that structurally lower OPEX run rate, giving flexibility to reinvest in growth. A growth foundation. We need to continue to build a platform for sustainable organic growth and leverage the category strengths that we already have. And finally, number 4, strategic opportunities. We need to continue to pursue value accretive M&A and focus on core revenue drivers when we're looking at those opportunities. So I can say to you that now EXL is operating from a stronger, more efficient cost base. We're well positioned to capture growth, both organically and via M&A, and deliver long-term shareholder value. If I can pick up on that concept of shareholder value, or at least relative to market value to some of our peers, reviewing other microcaps in the food and health space, several of our similar sized or even smaller peers are valued at 1 to 1.5 times revenue. We're currently at 0.25 times revenue, and that's off the back of the best quarter in the business's history. So I'll leave it to the audience to make their own decisions on whether that creates an opportunity for you. I haven't focused too much through the presentation on the new management team and board who have been delivering these improved results in the back end of 2025. But it is worth flagging that these have been hard fought in a really challenging year of transformation, and the team are excited about the year ahead. The obligatory disclaimer for our friends at ASIC. And then finally, thank you for taking the time to listen to the information about Elixinol and where we're heading. I look forward to some Q&A with you, Mark.
Gavin, thanks very much. It was good to get an overview of the story. I might just kick off with a couple of questions here. The first one, the vertical integration. We have a lot of companies present on here, and some completely outsource manufacturing, and they just worry on building brand and managing distribution, or they're very focused on manufacturing and they leave the distribution and all that to somebody else. So maybe just talk through from Elixinol's point of view, like why that vertical integration across the various products is so key for you, or do you see that changing as part of the evolution through kind of to 2026?
Yeah, look, it's a good question, Mark, and it probably goes a bit to the heritage of one of the key parts of the business, which is the hemp part of the business. It started off with aspirations to grow right from the farm gate, the product range, value add it by dehulling the seeds and then packing it and delivering to market. So currently we work very closely with partner farm groups to supply the raw materials, but we then dry that hemp seed and then we also dehull it and pack it off at our facility in Newtown in Geelong. So that is a fairly complete vertical integration. With some of the other product range, we don't currently do that, but it probably gives a bit of a hint to our aspirations as we scale and some of the M&A targets, that having the ability to control the manufacturing on more of our product range and in the Healthy Chef range is one of the good examples of that, is part of our aspirations, because we believe there's a range of cost synergies in controlling that manufacturing and definitely spreading that across the brands. And as I outlined at the outset, I've recently had experience of extracting those synergies by bringing brands and manufacturing into one entity and being able to sort of internalize those margins, if you like. And that's definitely something we're looking to do more of as we move forward and scale.
You touched on M&A there just at the end of your presentation. In terms of targets that you're looking for, is it someone who's got maybe an established brand, but they're only in e-commerce, online, direct to consumer play, and you think that would fit nicely within your portfolio, with the view of, oh well, we've got all our kind of connections within if we Harris Farm or Coles or whatever, and we can take it from being a purely D2C to a broader consumer brand. Would that be fair to say? It's like those kind of brands you're looking at?
Yeah, look, I think again, that question is a good one in terms of a big part of the platform that we've built is the exposure across all of those areas. So we have the D2C e-commerce, we also have the retail relationships, we operate cross-border, and we also have degrees of vertical integration. So I think it really gives us a lot of optionality in terms of the businesses that we can acquire, because they can plug into that and enhance a range of those elements. We're not just a DTC business or just a retail or just a manufacturer. So it gives us a lot of flexibility. I think the market is it's a good time to be looking at adding scale through M&A. The market has been stagnant for a while in terms of transactions, and there's a range of businesses that are keen to become part of something larger. So our intent is to work through a range of those options and work out any sequencing or which ones are going to add the most value most quickly. Scale is important. I think the listeners would understand that being subscale and listed is not a long-term proposition. So you need to build that scale to remain as a viable and profitable listed entity. But obviously, as well as that, for our shareholders who are already on board and those that we're seeking to encourage to join us and take part in this vision, we need to make those acquisitions value accretive. We need to continue to build that share value for each of our shareholders. So, as I said, there's the platform that we've got gives more optionality than I think a lot of businesses have in terms of what can add value and add scale in the short to medium term.
You talked there at the outset, being a transformational year and a lot of restructuring and costs out, how and hard decisions had to be made this last financial year. As we move into 2026, are you expecting further costs out, or are you kind of happy now that any costs that kind of come along in 2026, they're going to be like related to revenue, related to to growth, rather than kind of a major capex that has to happen, or kind of investing ahead of kind of potential growth.
Yeah, look, definitely. I think, in these style of businesses, you're always looking for efficiencies and to continue to improve your margins and take costs out. But we did a lot of the heavy lifting over the last 12 months on integrations of previous transactions, but also just right sizing that cost base. I think for those who know the back history of Elixinol, at one stage it was a much more ambitious international play into the US market. And, when I sort of moved into the business, they were still right sizing the corporate cost and the scale of the business for what it is now, which is a 15 to $20 million revenue, primarily domestic food business. So we'll continue to push to make sure we're investing shareholders' funds in the right elements of cost to keep growing the business and improve profitability. But we did a lot of that heavy lifting. There is some still legacy costs that'll play out through the first half of this year, but that Q4 number is much closer to the run rate that we believe this business can sustain and be profitable in 26.
Just on the US business, I know it's a ever evolving situation, but impacts from tariffs or not, or maybe just give us a sense of where. I know it's hard to say because it keeps changing every few weeks, it
Yeah.
seems like, but like where things kind of currently sit at now.
So look, the US business is sheltered from tariffs because those products are actually produced in the US. So the products that we sell there are domestically produced. So that's actually the sort of cross-border challenges around tariffs is actually working to our advantage at the moment. What's not working to our advantage is that the regulatory regime around CBD products in the US has been bouncing around a bit in the last 6 months. And whilst we're getting indications that there's going to be more regulatory clarity in the coming months, which will sort of give that business a clearer pathway forward. That's probably the main thing we're watching, rather than the tariffs, as the domestic regulatory setting or framework there. But the indications for our partners on the ground over there are that they're increasingly confident that there's going to be a strong future for those style of products for the right operators. And Elixinol has been in that market and is seen as a genuine and proven product that approaches that market in the right way. Whereas some of the regulatory changes are probably more trying to capture recent entrants who are not necessarily looking at the health and wellness aspects of CBD.
There's quite a change in the channel mix this year, as you pointed out from those pie charts. Should we expect the way we closed out 2025 to kind of reflect that way again in 2026, or do you see the e-commerce piece becoming even bigger in 2026? I know you've talked about refreshing some of the brands there, which are on shelves. So obviously, retail maybe might get a pickup this year, but maybe what do you think of channel mix as we go forward?
Yeah, I actually, when I was looking at those charts, envisaged the end of FY26, and obviously we've got our forecasts and the like, but we expect the dollar value of e-commerce to continue to grow because we've launched some really new and interesting and sort of on-topic products in that space. We've got a metabolic burn product, which to some extent captures some of that GLP-1 audience that is a growing factor in food and nutrition. We've got a nutritional water that is a high growth product in that space where consumers are starting to move away from some of those powdered protein products into lighter flavored or lighter water style protein products. So we expect that to continue to grow. We have contracted increased volumes in our B2B space. So that shrunk a bit in FY25, and now we're going to actually increase that sort of back beyond FY24 levels. So that'll offset from a percentage perspective a little bit of the total pie of what's e-commerce versus retail and wholesale. And you touched on the other piece in terms of the retail landscape. There's been quite a consolidation phase with the major retailers in particular. Some of your audience will probably know that there's been some range rationalisation across Coles and Woolworths in all their aisles, but definitely in their health and wellness aisles. And that has meant that there's probably been a bit of contraction in that. We've had the really positive result with our innovation around the Mount Elephant brand to get new ranging with some of those sustainability plays with our pancake shaker mix that's going to go onto cold shelves in the next couple of months. So we've actually had some wins in amongst that rationalisation. So look, to answer your question, with all those factors moving, I suspect we'll be relatively similar around that sort of 40% mark for e-commerce, maybe pushing towards 45. But definitely the pie, the overall size of the pie will be growing because we're quite bullish about growth, but profitable growth across all the key facets of the business.
Gavin, we're pretty much bang on time. Thank you very much. We'll leave it there, and hopefully we can catch up with you maybe at the half year result and get an update of how 26 is kicking off.
Yeah, that'd be great, Mark. Really appreciate the time, and thanks for people for tuning in. Thank you.
Thanks, Gavin. And I am just going to quickly get the slides up here for our next presenter, Adam Boyd from Vault Group. Adam, you're very welcome back. Thanks for coming back in to give us an update on the full year results. Interesting. Not a lot of companies have a December year end, and yet we have two here this morning with December year ends. So we can give us the Vault download for the 2025 year.
Thanks, Mark. Yeah, it's good to be back. Thanks for inviting me. And I thought you'd planned that, having two presenters with December year end, because it's something I now don't have to explain any further. But yeah, look, thanks to the audience too for joining in to see this presentation. Our business released the full year result last Friday, so obviously it was opportune, which is why you invited us, Mark. In terms of my role in the Vault Group, I'm the executive chairman. I'm the largest shareholder, and essentially I'm across all aspects of the business, whether it's setting our strategic objectives, acquisitions, operational management. And we've got a team now of approximately 25 people in the group working across what you can see from the first slide is 4 separately branded business divisions, which we'll go through in the discussion. If you can go to the next slide, Mark, that'd be great. There's the disclaimer, which we can move past for you guys to read when you wish. Now, firstly, what we do at Vault is essentially and simply put, we develop or acquire scalable proprietary service and equipment technologies that we target into supplying to the mining sector. So we've got 4 businesses, but the 4th that we recently acquired, which is 4D Delta, isn't reflected in these numbers. So we're going to go through the numbers for the year that exclude 4D because we only acquired the business on the 7th of January. So you can see the 4 tiles at the top here. The first on the left talks about our revenue, which is less than the prior year. Predominantly, that was the result of two things. We changed our African distribution partner in 2024-25. So our revenues were lower there, and that's for our West Coast business. And West Coast also too ended up doing $500,000 of sales in the first week of January that we didn't quite get into 2025. That'll benefit our future numbers, but they're the reasons that the ordinary revenue was lower. Our businesses are all EBITDA positive. You can see from those numbers that we are a profitable business across our divisions. Those numbers were lower than the prior year, but predominantly the result of some one-off costs. I mentioned earlier that we acquired 4D Delta. There was a lot of transaction costs in 2025 as we advanced that transaction that we announced in November 25. And also in the year, we developed a residential household energy storage system, a battery, which we can talk about a little later. But those one-off product development costs were about $250,000. And if you add those back to the EBITDA number, we actually did improve our underlying EBITDA performance, which is also reflected in our operating cash flow numbers, which increased by 10%. Obviously, the highlight from a corporate perspective was acquiring 4D Delta. We'll talk about that business, but it's an asset condition monitoring technology business that has an extensive client base in the mining sector. We're excited to have been able to acquire it, and it looks set for some good growth this year, with a budget set at between $4.5 million and $5 million. If you add that to our ordinary revenues last year, you can see where we'll be in the future, which will be revenues above $10 million, and certainly an increased EBITDA from the performance that we expect from 4D Delta. Mark, are you okay to go to the next slide? Thank you. This slide's just a summary of the result as presented in our full year financial statements. It really covers what we've just talked about. And I think that's for people to look at later on. So we can move to the next slide, Mark. So I'm going to talk about each of our businesses. I think that you can see from the picture there, the tactile view of the product we produce is our EcoQuip business rather produces as a mobile solar light and communications tower. This is a product we developed ourselves, one of our own OEM proprietary technologies, which we've had some success with. What's exciting about this product is that its ability to achieve charge efficiencies is significantly better than anything else in the marketplace. So what you have in the marketplace for this product is a number of alternative, apparently similar products. They're all made in China. Unfortunately, they use off-the-shelf technology. So what you find is their charge performance is not as robust as our solution, which means we've got certainly a competitive advantage in the marketplace, which we've been working hard to communicate into the mining sector, and we've had some success there. So that does two things. One, it provides for a far more reliable product than the industry's experienced from solar lighting in the past. And two, with that reliability and the charge efficiency comes the ability to displace diesel light towers. And if you add up the cost of a diesel light tower compared to what we charge for supply of this product under a rental model, it can reduce the costs of these assets to the miners by about 50%. If you can go to the next slide, Mark, please. Okay, so what happened in 2025 in this business? We grew the revenue slightly. We built 30 new units for deployment to our customers, and we've firmed up our 5 active clients. So this business really only started to commercialize in the last few years. One of the highlights of the business is we were able to get the product deployed on Barrow Island, which is obviously has the Gorgon natural gas project owned and operated by Chevron and its partners. We signed a 5-year agreement that comes up for renewal this year, and we're just working with Chevron now to discern what we're going to do going forward with them to extend the contract and keep that fleet on that site. Some of our other active customers are Tees, Westgold, McMahon, and Evolution. We're currently working closely with Westgold to displace their diesel fleet across their mine sites with our product. We expect that should increase our fleet such that the total number of light towers Westgold will have will be between 25 and 30 units. So that's an exciting development for us. We had Chevron take a large parcel, and we've had a number of hard rock mining parties that you can see there that have trialed and slowly expanded their fleets, but none of them have made the decision to comprehensively displace their diesel lighting assets on their mine sites. And we've managed to work with Westgold and prove the product to the point where they're now willing to do that, which is a terrific development for us. And we hope to leverage off that to effectively really push this business into fleet deployment and revenue growth in the next 12 months, which is a key focus going forward. What's good about the business for us is the scalability. What's great about EcoQuip is if you contemplate the total addressable market, we're talking at least 5,000 light towers in the mining sector in Western Australia alone. If we got 10% of that market, that'd see revenues for us of about $15 million. Our supply chain is quite robust. Most of our equipment we manufacture in the United States for cost and technology capability reasons. So we're looking forward to really pushing the growth of that business in 2026 going forward. Next slide, please, Mark. Okay, 4D Delta. This is the business we've just recently acquired. So what 4D Delta is a digital asset inspection and condition monitoring business. It supplies this technology to the mining sector. The business was founded some time ago and has developed its own proprietary technology that it delivers an enormous step change in the evaluation of wear rates and asset management in particularly bulk commodity mining operations. If you go to the next slide, Mark. So 4D Delta over the last few years before we acquired it has really grown its business very successfully. It's currently in a position where it's scanning 730 plus assets at various mine sites. It's been able to execute its services for companies like you can see there, most tier 1 miners in Australia, Rio, BHP, Alcoa, South32, and is now focusing on capturing the other tier 1 miners. The business, effectively what it does is it dramatically improves the ability of mining companies to discern the condition of a number of their assets that are subject to wear. So historically, they've inspected those assets at shutdowns visually and with technologies, off-the-shelf technologies that do not give them a complete set of data or the true information about their wear levels on their assets. What 4D Delta's technology does, using technology and its software, is enables the miners to, and particularly their reliability engineers that are responsible for decisions around changing wear plates in assets and doing extensive or choices between extensive maintenance, which increases shutdown periods, or reducing the level of maintenance, which reduces shutdown and therefore gives them more production time. That the technology gives them absolute data to make decisions, and you can see by the uptake of the relevant mining companies, sophisticated mining companies that 4D Delta works with, that there's a real value benefit which they're recognising from using this technology. The business or the management team at 4D Delta has also been very active in pursuing its global growth endeavours. They've partnered with a business in the United States that does a lot of surveying and measurement activities for large industrial feedstock and resource sector businesses. In this case, they've been able to capture with their partner Wingfield, using the 4D Delta at a lot of major cement and lime assets, production assets in the US, which really bodes well for the continued scalability of this business. So for FY26 for 4D Delta, like EcoQuip, this business is really focusing on its revenue growth. It's demonstrated the capability of its technology with its customer base. It's really slightly ahead of EcoQuip in that regard. And you can see that where the business is at in terms of its revenue generation and earnings budgets for 2026 is we're targeting the higher end of this revenue range that we provided of 4.7 million. It's early days in the year, but we think we're going to be able to achieve that and maybe exceed it. And the EBITDA performance also in that higher range. None of these numbers, of course, are in the group numbers that we've talked about earlier for FY25. So, the group overall with EcoQuip's expected growth and growth from 4D Delta is really looking to significantly deliver significantly better results in 2026. I think the next slide would be good. Okay, here's our third business. This is a well-established business actually, and is a really positive revenue and earnings generator, cash flow generator for the group. Westcone was originally established in the late 90s. It is a business that manufactures and supplies sample crushers to the resource sector. So a business model there is to sell and refurbish crushers back at our workshop for the large miners. It's a unique global product. It's used in North America, Africa, but predominantly here in Australia, with some deployments, small deployments in Europe. If you go to the next slide, Mark. So Westcone in our FY25 delivered a revenue of 3.3 million. We talked about that being slightly lower than the last year due to our African partner transition. Fortunately, what the hurdle that was slowing us up was getting through Anglo American's vendor process. Anglo American has approximately 14 Westcone crushers on their iron ore sites in the Northern Cape of South Africa. We are now servicing them again and able to supply Westcone crushers on an exclusive basis. So we expect to see improvement in Westcone's results in 2026. During the year, we worked quite closely with Rio Tinto. Some of their mine site assets are no longer mountains. Something like Mount Newman isn't a mountain anymore, it's a hole, and they're getting into the water table, which is delivering or presenting higher moisture iron ore production to their processing plants. And in the case of Westcone, our crushers, that has reduced the life cycle performance in some locations on their assets of the crusher. Fortunately for us, excuse me. Sorry, my camera's gone off. I see. Fortunately for us, we've been able to create a new design modification to our crusher, which allows them to produce higher moisture, well, to process higher moisture feed. We've been able to patent that, and now from going forward, we've been able to increase the price of that product, and now Rio Tinto exclusively only use that modified product on their sites. We've also got a patent now this year for our Series 4 and we're crusher, which we will look to expand into North American markets this year. A10 is our waste heat to power tech. This hasn't been commercialized yet. It's essentially what it does is it can be retrofitted to existing open cycle gas-fired power stations. It uses the waste heat from their exhaust to generate incremental electricity from those assets. The incremental electricity generated is about 15 to 30%, and we do that at a significantly lower cost, like 20% of the cost of the gas-fired power. So net, what you end up with is if you retrofit this technology to an existing open cycle power station, it will increase the level of generation by 15 to 30%. It'll reduce the overall costs of the combined facility by 15%, and it reduces the carbon intensity of the facility by 15 to 30% because that incremental power doesn't use any more gas to generate it. So our commercialization endeavours with this technology are ongoing. We certainly have spent quite a bit of time with a number of open cycle power station owners in the last half of this year. The bullet points here, or the tiles here, highlight the opportunity for the technology. We can install between 20 and 80 megawatts of base load capacity from installing the technology on an existing open cycle power station. The overall levelized cost of energy, which includes the cost of the capital investment, is significantly cheaper than gas-fired generation and also significantly cheaper than solar. Paybacks are about 4 years in most circumstances in relation to those examples we've studied and worked with customers on. We did a concept study early in the year for the state-owned power generator here in Western Australia, which is where the company's based. That business is called Synergy, and we've worked with them to prioritise which power stations will optimally benefit from the technology, and we're now working with various owners of power stations we've identified to seek to deploy the technology on those assets. What's good about the tech is as the zero emission technology or energy transition has occurred, it's become clear through that process now that gas is going to play a major role in maintaining energy security in our power networks. There's a number of existing open cycle gas-fired power stations that are going to have a higher level of duty operation as coal continues to be retired. And those power stations are ideally suited for this technology, where we can increase their capacity, reduce their cost of generation, and reduce the emission profile or the carbon intensity of those power stations by retrofitting this technology. So we're still working quite hard, and we're quite optimistic about the potential of this technology. But hopefully we'll achieve some outcomes in 2026 that will initiate its commercialization here. in terms of that technology risk, what is great is, albeit we do have a patent on this product here in Australia, an Australian innovation patent. There's a number of very similar facilities deployed in the US and Europe. So we have demonstration assets, and the components are all subsystems manufactured by existing manufacturers with deployed track records in industry and power generation in Europe and the United States. So we're not seeking to install a unproven technology in the case of A10. Mark, if you could go to the next slide. Okay, this is probably the most important slide in the presentation. What this outlines is what our 2026 target revenues and EBITDA for the business, and then a medium-term target EBITDA that we are pursuing probably to achieve within the next 3 years. So with our West Coast business, you can see our target revenues are similar to what we did this year. In 2026, we expect to achieve the high end of that outcome and that EBITDA. The two areas of growth that we think we'll achieve in West Coast that should see us outperform that budget, if we can, is moving back into selling into Africa, and also FMG as they progress the commissioning of Iron Bridge, which is delayed. There is a number of our West Coast crushers deployed at Iron Bridge that will require refurbishment on a regular basis on that asset, given the nature of it. So that should deliver some further growth in West Coast. Our EcoQuip business, we think, as we discussed earlier, with the type of quality clients we're dealing with, whether it's Chevron, Westgold, Thiess, Macmahon's, and a few others, that we're just in a position now to really further grow that business. What we're trying to do is double the revenues, which will require us to, over the year, deploy about another 80 to 100 light towers to do that. We think that's imminently possible. We're working hard and growing our sales team in that business to do that. And we will obviously keep the market updated in relation to how EcoQuip's growth is going. We don't expect to generate any revenues from A10 in 2026. And then as we continue to commercialize that and with 4D Delta, we talked about the budget earlier of 4.2 to 4.7. We're striving to chase the high end of that sales revenue estimate. So net, we think that in 2026, we'll achieve revenues of between 11 and exceeding 12. That's the range we're looking for. We're certainly chasing 12 or more, and we hope that we'll achieve that or demonstrate that in the first quarter we're on target for that, albeit there's a bit more to go. EBITDA, we've extensively done our budgets. We think that EBITDA is imminently achievable with our revenue forecast that we've got. So you can see from there, compared to what we did this year, which is a 1.4 adjusted maybe to 1.8 with the non-recurring costs we incurred, you can see a substantial growth in EBITDA that we expect in 2026. Then you've got the medium-term EBITDA. Can we achieve it? You can see that we've given where we think that increase in EBITDA is going to come from in the medium term, which is our kind of 3-year target. We think that's still achievable. Nothing's changed in the business since the end of the year that gives us any view that we won't be able to achieve those growth outcomes that we've put there in the medium term. So I'm excited about that. Can you go to the next slide, Mark, please? So this is a summary of where our business is, what we're targeting in 2026, and it's all about sales growth. We've got two businesses, EcoQuip and 4D Delta now, that have successfully developed valuable service and equipment technologies for the mining sector, and we've penetrated those markets with those technologies. The potential to continue to grow is significant. Our penetration, whilst it's meaningful, it by no means is close to anywhere near the total addressable market. And we're really focused this year on sales growth across the group businesses. Most of that will come from EcoQuip and 4D Delta, but we're also expecting Westcone will deliver a significant portion of that as well. Our businesses why we think we can do that is, at the same time as maintaining our margin, is because all our products deliver significant cost benefits to our customers. We're certainly not delivering anything that requires them to achieve any efficiencies elsewhere, any other changes within their business. We will deliver cost savings for clients with proprietary technologies that can't be copied or replicated by other parties. And it's that key competitive advantage aspect of our strategy that puts the business in a position to grow its revenues and maintain its margins, which a lot of businesses in other industries have great difficulty doing. Part of that growth is we will be pushing back into Africa with Westcone, continuing to push into the United States with EcoQuip and 4D Delta. So we do think that we can at least expand our foothold in those markets, so we develop more of a foundation to continue to accelerate the growth in those markets. So yeah, well, what I think is important to communicate here to all the participants is we're transitioning from all our businesses having a material portion of their activities around technology development and enhancement to shifting to a less of technology development and more of a sales focus. And that's what's going to give us the growth now that we think we haven't achieved in the past, and we think will deliver investors, including myself, a significantly improved value outcome.
We're just up on time here, but I do want to, if you've got 2 or 3 more minutes, if we can just tackle one of the questions from the audience, because I think it's pertinent. They said, first time listening to the Bold story, but the question is, the 4 business units are quite disparate. Is the board wedded to continuing to operate all 4 units, given they don't seem synergistically overlapping in any obvious manner? And maybe just kind of touch on, because I know you did touch on this in our first presentation, which was back, I think, end of November, December, about kind of how, the 4 units and both kind of sees itself operating within the kind of broader mining sector.
Well, I think firstly, the board's always open to opportunities to create value. If that means there's a greater value pathway with the businesses not all combined within the group, we'll look at it, Mark. What I will say, though, is I don't necessarily agree that there's no synergies between the businesses. I mean, firstly, our market and customer base are common between nearly all of them. And as we develop, even if one of our businesses has success with a customer before the others, the benefits our proprietary technologies give those businesses delivers a credibility persona for our business that allows us to access those customers to trial and allows us to demonstrate our other technologies. So I do think that there is synergies within the marketplace. And the other aspect of it is both 4D Delta and EcoQuip in particular have a significant software and technology capability that really cross-fertilizes across businesses in terms of the capability of the staff. If you're going to develop a product that has software and electronics, I don't agree there's no synergies between them to benefit from the capabilities across the businesses where there's common capability needed. And that goes for mechanical engineering as well between EcoQuip and Westcone. So if you go to the root of how these technologies have been developed, there's capability there that can be used, and we do use across the businesses. And that's a value creating opportunity for us.
Adam, we will leave it there. Thank you very much for coming back with us and talking through the results half the press. And yeah, maybe we can touch base in August when the first half result is out with us, and we can get an update on how things are going. But thank you very much for joining us. Just a reminder for anyone who is joining us, we are back again at 2 p.m. this afternoon. We've got 2 sessions today. We're back with Martin Filz from Pureprofile, another regular presenter who will be joining us at 2. So I look forward to seeing you then. And thanks to Adam. Thanks, everyone. Okay, good afternoon, everyone, and welcome to our second session of the day with our results season lineup of events. I'm delighted to be doing our second one of the day, and I'm just going to quickly run through our standard set of intro slides, and then we'll get straight into it with our presenter for this afternoon. My name is Mark Tobin. I'm the founder of Coffee Microcaps for anybody who's joining us for the first time. And I would like to give a shout out to DMX Asset Management, who are our virtual event sponsor here for 2026. If you are looking for an active manager in the small/microcap space, please do check out their website for the relevant PDS and TMD, or indeed reach out to Stephen or Michael. I'm sure they'll be able to provide you with any information you might need. Compliance and disclaimer, and welcome back to ASIC if they're joining us. Standard fair 300 million, that's our definition of microcap. Companies we have on here in revenue, approaching cash flow break even, or indeed are already profitable. We tend not to have companies from the resource and biotech sector, what I like to call industrial microcaps, which kind of encompasses kind of everything outside of resources and biotech. So financial services, technology, professional services businesses, and everything in between. We've only got one company presenting, but what we're, I think, losing in quantity, we're going to make up in quality here with our returning presenter, who should be no stranger to anyone. Again, if you want to follow us, we're on all the kind of main social media channels, and I do a newsletter on Substack. The next edition of that will be coming out in middle of next week, once we get through all these webinars, and all the links to all our webinars will be in that newsletter. So if you do happen to miss anything during this week, as we have 12 companies presenting, you can catch them up on YouTube and in the newsletter. And I'm delighted to welcome back Martin Filz. Should be a stranger to nobody here. He's a regular presenter both in person and online. Delighted to have him back, Martin. I am going to stop sharing my screen and hand you over to run us through the latest Pureprofile results.
Great. Thank you very much, Mark, for the introduction. And hello, everybody. Thank you for joining the presentation. Let me just bring this up. So basically what I'm going to run through today is just a slightly shorter version of what we presented for our audited half one results for this financial year of Pureprofile. So can you see my screen okay there, Mark?
Yeah, I can indeed. Yeah, we're on the disclaimer slide now.
Perfectly. All right. So roundabout way. So, but just to kick off with a little bit of financials first, because these are audited numbers. So, the profit for the half year, so that's profit after tax, was 1.9 million. So up 22% on prior year. So excited about that. There's a little bit of deferred tax in there, but actually, if you look at profit before tax, it was up as well. But up 22% profit. So as a microcap, making real money, which is quite nice to see. EPS was up 21%. So again, showing the shareholder return. Cash at bank, 5.9 million, up from 5.7 at the close of last financial year. Our revenues for the half was up 14%, which equals to a 5-year CAGR of 22%. So that continued growth. It was another record 2 quarters and record half for Pureprofile, as it has been for the last 5.5 years. EBITDA growth up 14%, equally on 3.8 million. And so that's 11% maintained margin, even though we had some ongoing investment because we continued to grow and invest around the world, and also a little bit of foreign exchange negativity in that. So still maintained that 11% margin, which is great. Rest of the world revenue, really important for those that have been on the journey with me for the last few years, and Pureprofile even longer. It's about being a global company, and in both quarters, and then the half rest of the world now overtook ANZ, and that's obviously a big change. 5.5 years ago, ANZ made up 78% of our business. Today, rest of the world, that strategy is working. Rest of the world grew 30%, so that's 16.8 million. So that's again 5-year CAGR of 38%. So really consistent 5-year CAGR, great to see. ANZ up 2% with the industry leaders here in Australia, and so with a lion's share of the market, and we saw 2% growth in the company. And then platform, really important to us, again a cornerstone of our strategy. Platform up 54%. Why is that important? Because platform brings efficiency, it increases EBITDA margin, gives clients more options in different ways of working with us. So that's sort of, if you like, an executive summary of the half. We also made another acquisition. So this is the second acquisition we've made in the last 2 years after we bought iLink the beginning of financial year 25. So we bought a company called Cornerstone, which is qualitative research. So we're a data company, and within the data company, we do quantitative research. So ask lots of people something to give feedback or answer a business question. Qualitative asks a smaller group of questions, a really deep dive. So it could be in focus group rooms, it could be online qualitative research, but I really want people's opinions. So it's a lovely adjacent business to Pureprofile. It makes up about 20% of the addressable market in the data and insight space. If you say quantitative is 80%, qualitative 20%, so it makes complete sense, and it's a bolt-on. So as I said all of that about smaller groups, understanding the why. As a business, last year we did about $300,000 in qualitative research through outsourced partners. We were just trying that out. So we know how to sell it. Our clients were already buying it, and that was a trial to see if it would work as an add-on for us. Clients moving to both, and so it makes complete sense as a bolt-on. So purchase price was 700,000 Australian for cash. We have 50,000 one-off transaction costs. As the previous slide said, sorry, it didn't say in there, that's about 300,000 EBITDA dollars pre-synergies, not post-synergies, but pre-synergies. So it's about 2 times pre-synergies EBITDA. So good use of capital, nice adjacent business. They're delivering about $3 million of revenue. As I said, 300,000 of EBITDA. So it's accretive to us as a business, and it's a nice bolt-on for us. We can cross-sell that into our Australian base. It's a natural fit. We're already doing the work. So very happy with that. And that would see then again, Australia, it's about $35 million of revenue. So if Australia this half organically had grown 2%, if we'd have had Cornerstone, it would have been at about 12% growth. And with Cornerstone, we know there's strong growth possibilities that we can take $3 million much higher as well. So very happy with that acquisition, and the feedback from investors is that's a very good use of capital. So Pureprofile at a glance, as I said, for those of you who don't know, we're a data company. So 900 plus clients around the world come to Pureprofile because they have business questions. They want to understand something about their customers or their competitive customers, or what their advertising campaign, or if their political party, their messaging that they're giving out. And so they come to Pureprofile because either to access data, so I can just access data through SaaS systems, or I want to run surveys and actually get my question answered. So that's what we do. We're a data company delivering answers to 900 plus businesses around the world. We have 14 offices globally, 962 clients, 206 staff. We're a really established business, 26 years old this year. Talked about that, 33 million for the half year. In our platform revenue, it's now 9.4 million. So that's getting towards 30% of revenue comes from platform. 5.5 years ago, that was almost zero. Why is that important? EBITDA margin expansion, as I said, new scale with clients, different types of clients, and in effect, no excuse for clients to work with you. They can come to you whether they want to use an API or whether they want to use DIY tools or whether they want a white glove managed service type offering. There are no barriers to clients working with us. And then about $14 million is in annuity revenue. So again, that's considerably up from previous years. And again, that shows that that's repeat business, long-term contracts. So they might have signed up for a SaaS contract, long-term contract, or we're actually doing ad hoc projects, but it might be a multi-year project. So that's a snapshot of Pureprofile. And in the last year, we did research across 112 countries. I talked about this, and again, sort of getting into financials a little bit. So profit, as said, was up 22%, which is great to see as a business. It shows money's flowing down to the bottom line. We're seeing operating leverage now as a company as we grow the top line, more of those dollars flowing through to the bottom. The record half. Platform has said 54%. Rest of the world, really onwards and upwards. And feedback again from investors, what they've been particularly excited about the rest of the world is as that becomes the majority of our business, we start to reflect that growth profile. So Pureprofile, as rest of the world continues to grow, starts to look like 30% growth company, as that will be the major part of our business. So very, very excited about that as a business. We have lovely graphs, and so you can see since 21, and importantly, you can go back to our reports like this into financial year 21, and every metric is identical. So if you want to look at revenue, EBITDA, losses then, profits now, they're all completely comparable. They are calculated in exactly the same way. We've made no changes to the way that we report our data in Pureprofile. So it's like for like. So you can see lovely graphs, continual growth across revenue, and then as a 22% CAGR, and then we're seeing rest of the world go from that 28% now to just being the lion's share of the business. Again, when you look at EBITDA at the bottom right, one can see within that continual EBITDA and margin expansion as well. We're growing because of reputation, quality of service, quality of delivery, quality of data, really important in our space. We're not growing because we're buying revenue. If we were buying revenue, you would see our gross margins drop, you would see EBITDA margins drop. So this is all growth, which is actually ROI based growth. And the big one we've got on the left-hand side, and a lot of focus on that, is platform. And again, that's fed to the fact that we've gone from 5% or so EBITDA margin 5 years ago to now for the half 11%. Prior to, we've now released our audited numbers. I've been through most of this. I think, yeah, we talked through that. So, profit and loss after tax, it's now sitting at 1.9. So it's truly, I think 2 years ago, our full year profit was $100,000. Last year, our full year profit before tax, because we didn't have tax to pay, was 1.6 million. And now in the half, net profit after tax is 1.9. So we're excited about that, very excited about that. And everything else pretty consistent across the business. Cash flow, so cash at bank has increased, and so we've seen that increase by $800,000. Financing cash flow is remains steady at 400,000, and total cash flow is 200,000. It again is the dollars are flowing through the business and into the operator cash flow. So again, established business, very different to how we were a few years ago. And then we reaffirmed our guidance, increased our guidance. So we had given initial guidance of 62 to 64, I think it was. We upped that 64 to 65 EBITDA margin, 10 to 11, and we've reiterated that guidance. So we're now beginning of March, so the financial year is almost done. Where has all this come from? 5.5 years ago, we put in a clear strategy of the business, had a pivot which said, one, we need to be global. Majority of the data and insights world sits in US, sits in Europe, doesn't sit in Australia, and we're number one in Australia, and it was our biggest market as a company. Be global. That's what companies, their clients want. They want to deal with global businesses so they can have a one-stop shop. The second point was technology. You need automation, you need automated processes, you need automated ways clients can work with you, be more efficient, work with more clients, and increase that EBITDA margin. And then absolutely focus down on data, and then data and insights. And data key today, because as we move into the AI world, and you see lots more today, and you're all, I'm sure, using AI in your day-to-day life. AI is nothing without data. The purest form of data is coming to somebody like Pureprofile, and we have the source of data. If I've got behavioral data on people that have joined my audiences around the world, that's the purest force. If I ask them questions, that is their immediate feeling, sentiment, etc. And versus if I've scraped this as an LLM might do on Reddit or on Facebook, I don't know what's a bot, I don't know what's real. So Pureprofile data is becoming much more important as in the world we move more and more to AI. So we're in a great place. Why is globally important? As I said, 54% of our industry sits within the US. And so we need to tap into that runway and tap into that addressable market. For those who don't know, a bit of history, I talked about a little bit pivot that we did in 21. So I joined in financial year 21. We did a restructure of the company, got rid of some advertising assets that we had, focused purely on a data and insights company, and then launched from that debt to equity swap. I changed the management team, brought in, I think, 34 new people, which would net of 3 new people in the business. Then we spent 22 to 24 re-engineering the business to ensure we were truly global. somebody sitting in New York or London or Amsterdam, whether you're a client or whether you're an employee, has exactly the same experience using exactly the same systems. So being true global follow the sun company, and at the same time growing as a business and rolling out our new technologies, reinvesting dollars perhaps back into those new technologies, which hadn't historically been done at Pureprofile, so that we then finished at the end of financial year 24, where we've got new platforms. That's why you've seen a particular growth. We truly have an optimized, scalable way of working globally, and now we're leveraging that through financial year 25 and 26. So now it's really the period of kicking on. Even though the graphs look pretty good in the last few years, now it really is the time of kicking on. When we talk about 26, 27, I said we're nearly at the end of 26. Some things we think about. One of our goals, this used to be aspirational, was international revenue overtaking ANZ. We did this at the end of 25. That's great. It is now overtaking it. And we are by the end of 27, we say we want to double the UK revenue and triple the US business revenue. So again, that continues to grow away from that ANZ business, and we become truly international. Product expansion, triple the platform business revenue. So we're 54% up in the year, which is fantastic, in the half. So that brings us scalability. It brings us EBITDA margin. So that's very important to us as a business. And we talked about this in the unaudited results. For the first time in the history of the company, both in Q1 and Q2, salaries grew at 10.7%, whereas revenue was growing at 14%. So as we've been investing in the company, salaries have always been at a higher level than our revenue growth. And we've seen EBITDA margin for other things that we've been doing, but we've been investing in people and growing people. We're now at the stage where we're able to leverage those investments. So you're seeing salaries growing at a smaller rate than our revenue growth, as I said, for the first time for the company, which is exciting. Looking at mergers and acquisitions, we've now purchased a cornerstone acquisition out of cash. Great use of cash, accretive for us as a business. Can we see the same sort of step change? Can we get a step change if we can make an acquisition in the US, or if we can make an acquisition in the UK? So that's also part of the discussions, what we look at. And again, being very disciplined, like we have been, about running the business, full stop. We've got to where we are today by being disciplined about running the business. As COO, CFO Mel absolutely looks at ROI before investing a dollar. And we're looking at the same thing within mergers. We're not buying something for the sake of doing something. It needs to be accretive, needs to be value added. One and one it makes three. Improving margins, we're seeing that across the business, and special focus. Again, we talked about this in 25. We've now seen that in 26 come to fruition, so excited about that. We buy in data when we can't generate our own. So maybe we're looking for 1,000 BMW drivers who have bought a car in the last 6 months in Amsterdam, and we only have 500 in our own audiences. So you go out and buy an additional 500, actually reducing the percentage that we spend, or increasing, sorry, I should say, the margins that we make on buying the missing data sources. So that's been a big focus. And again, a big part of rolling out platform. So we're seeing an increase also in the margins of the sample that we're bringing in, data we're bringing in. So very excited about that. And continue to roll out tech, be it AI or non-AI, to keep being leaner and more efficient as a business. We've got lots of new solutions. I won't dwell on this, but the key thing at the bottom is Data Rubico, launched at the end of financial year 25, and with the platform usage and end-to-end from clients through to supply of data, whether it's our own or third party, that's where you've now seen that big lift. So very excited about that. And then in summary, so record H1 results. We're seeing that sustained Q2 momentum. So it's for the year, we're seeing that, which is great. EBITDA growth 14%, even though, and again, we talked about that in the unaudited release, we saw some foreign exchange losses Otherwise, it would have been higher growth than that. Rest of the world, 30%, so that's great if that's the majority of our business, as I said. Platform revenue up 54%, great. That's where we're investing. That's where we're encouraging clients to go to. It makes us more profitable. And we won a couple of cool awards in the half. One big one that we won actually was we're recognised as Research Partner of the Year at our industry body, which is the Research Society Award. So as a company, we have 84% client satisfaction, which is very high NPS score, which is high if you follow those numbers in other companies. And actually, we have about a 94% repeat rate with clients. So we're doing very well, and that's underpinned by winning that award. And that's a smiling face of me. So thank you all very much, and back to you, Mark.
Cheers, thanks, Martin. I'm just going to take one question we have here from the audience so far. Jan, SMI data, Standard Media Index data shows further weakening in the Oz advertising spending. What do you see for this calendar year? Like, what is kind of feedback on the ground from the kind of brands that you're working with, I guess?
Yeah, oh God, Jan, we could do a whole session on that. It's really interesting. So and now obviously we've just got the conflict in Iran and kicking off as well. So the bottom line is, as I said, we're market leaders in Australia. So where you look at that 2% growth, I think with the CAGR is higher than that. We're seeing currently about 8% growth, but that's a sentiment in Australia. I can use that as a barometer as market leader. You're seeing that there aren't particularly any industries except now, as I said, the petrol industry, where you've got particular growth going on. And companies are looking at how can they be faster, how can they be cheaper in their whole supply chain by using AI, etc., etc. And so for us in Australia, where you are market leaders, as I said, in half, you see 2% growth. So we will combat that by making acquisitions, and that might be consolidating the space or buying interesting companies like Cornerstone. So that sets us back to the 10 to 15% growth. But in Australia, we're not the challenger brand, we're the market leader. What's the great thing for us is in the rest of the world, that 54% sitting in the US, for example, we're the challenger brand. So whilst you have the disruption going on in the world, which could be AI, it could be M&A activities that some of the big guys made, it could be the Iran conflict, whatever's causing macroeconomics to be affected, that's affecting the market leaders. For us, as a challenger brand, it's a perfect time to be that. You've got data becoming more and more important. You've got the large companies thinking, how can I implement AI and right size? And in our press, you just saw, I think, WiseTech laying off 4,000 people and their share price went up 20%. Somebody else laying off 2,000 people, share price gone up. And they're all claiming it's AI, but really they're using that as an umbrella to right size the company. Whenever you have disruption like that, it is absolutely brilliant to be the challenger brand. So really, really excited about that for us as a business. And sorry, Jan, if that didn't exactly answer your question, but there is global uncertainty at the moment. We've got high inflation here. That brings uncertainty. The US the inflation is 50% what it is here. So they don't have the same sort of problems that we have here. And companies aren't worried about their expenditure. Money is cheaper for them, so they can invest in services like data or advertising or upgrading facilities or whatever else they need to. So it's one of the really interesting things of being a global company, that I love running Pureprofile, and apart from that, it's amazing people and clients and growth and all that, and shareholders, thank you. we've got so many levers we can pull. I've got different products. One could be doing better than another. It doesn't matter. We've got levers we can pull, but the big lever is the geographic lever. And being in the 14 countries gives me absolute levers that I can pull as business. 5.5 years ago, I was 78% Australia. I would have just released results that said I grew at about 3%. We're in a lovely place as Pureprofile, very exciting, and that's why we had the strategy of being global. But Jan, happy to pick up that conversation separately and have a debate about the world if you'd like.
I will just mention while Martin was running through his presentation, I did just pop into the chat the latest RAS research report as well, because Pureprofile is covered by them, so you can pick that up in the chat if you haven't seen it already from Finola and the rest of the team at RAS. A question from me, Martin, given where the business has come from to where it is now, kind of pretty consistent, sustained, growing profitability, where does that lead then in terms of further capital management, in terms of kicking off with a dividend maybe at the full year, buybacks given maybe where the share price is now, further acquisitions, speeding up bolt-ons or slightly bigger bolt-ons? Maybe just give us a sense of where you, Melinda, and the board are kind of thinking, now that the profitability is there to go back to your previous point, to pull different levers on the capital management, things that weren't open to you 5 years ago.
Yeah, look, it's a really, again, a great question. And, ultimately, I can sit here and say, we have an amazing company. Again, look at all of our KGARs. We've got 98% of people recommend Pureprofile as a place to work. We've got a low single digit voluntary staff turnover, so 94% client repeat business. That's all amazing. I don't run a private company. So we would all be patting ourselves on the back going, well, look at us, this is absolutely amazing. Share price hasn't moved in the same way that you've got all of those metrics as the company has. And so for us as now, it's about saying, okay, let's look at as a CEO and as management team, we should never be focused on the share price. We should always be looking to build a great business, and the share price will follow. But what are the metrics that we look at? A belief, and I'll just say that, is doing buybacks or doing dividends at the level that we're at, because I can't guarantee if I started dividends now, am I going to pay dividends for the next 5 years? It might not happen. So it's not a guarantee. Buybacks, I've not seen buybacks really move a share price. So if we're looking, that is moving a share price, it's the best way to make accretive acquisitions and use capital much better to buy something like Cornerstone, $700,000, 2 times EBITDA with synergies, less than 1 times EBITDA. That's better use of capital than spending $700,000 doing buyback of shares. That should have a bigger impact. The other focus, and again, that's good, Jan's question, and where I thought you were heading a little bit at the beginning, is it's the next driver that's going to put it, is we've always invested our company investment within the makeup of or within our metrics. So we've always grown EBITDA, and that's going to carry on. From day one, we've never said we'll do a cash raise just to keep the lights on. We've always been operating cash flow positive from about 2 quarters that Mel and I came together. So the other thing now is to say, okay, with all of the AI and development enhancements you're doing, how can we move that EBITDA percentage now? Because for me, I see that the market goes great. It's another record from Pureprofile. That's amazing. Let's see that EBITDA margin percentage now increase. I think that will have a marked difference. How are we going to see that happen? By rolling out more platform, increasing more on platform, and making accretive acquisitions. So we see that as use capital. We've got that 2.7, I think it is, million with CBA, a debt facility with CBA, and that's interest and capital we're paying off. we've got enough money in the bank to pay that off. There are no covenants to that. There's no payout to that, but we're better off having that money in the bank to be able to make bolt-on acquisitions that don't dilute but actually are accretive. So that's how we think about cash today.
And then maybe if I follow on from that, because I thought, yeah, that was going to be roughly your answer. Acquisitions, to continue on the capital management of the three main options. Should we expect, further bolt-on acquisitions to more in the international business, given you say, you are the market leader in Australia, so the ability, I won't say the ability, the impact of doing a bolt-on acquisition in, I don't know, wherever, the US, the UK, maybe another market, it gives you more of a presence in those markets. So like, you go from, being number 8 in that market to number 6 in that market, and people are like, oh geez, your profile are moving up, they're kind of bigger, we know they're more around, they're doing deals, it kind of increases your presence. Whereas in Australia, everybody knows you already here, and while there might be opportune ones that come up, like the most recent one, would it be fair to say most acquisitions would probably be in the international space?
Yeah, good question. Look, just to pick up on one thing just really quickly. All of the top 10 in America do over $100 million of revenue just in America, and number 1 does about $300 million just in America. So we're not a number 6 or number 8 today. We do about $6 million US domestically in the US, first from remote teams with domestic work. So we've got a long way to go. I'd love to be 6 or 8. That would totally change the company. So that's first point in that. Yes, is the answer to your question. That's proactively, that's where we look at acquisitions. Proactively is in the US, trying to find something. We come close before being pipped at the post, or they've been wrong in DD or whatever. So that's proactively. Cornerstone was opportunistic, came along, made complete and utter sense, and that was an opportunistic acquisition. But yeah, US is the proactive focus.
Martin, we're slightly over time, so I think we'll leave it there. Thank you very much for joining us this afternoon, and yeah, let's catch up later in the year.
Brilliant, Mark, and thank you all for joining this afternoon as well.
Thanks, Martin. Thanks, everyone. And just a reminder for anyone, we have 5 companies presenting tomorrow afternoon and a further 4 companies presenting on Friday morning. So please do tune into our webinars tomorrow and Friday. Thank you.